Welcome to the Good Divorce Show, where we can help you learn how to navigate the journey of divorce with less conflict, less debt, and equip you not to just get divorced, but also learn how to be divorced. Your host, certified divorce coach Karen McNenny, shares her wealth of knowledge, gets advice from other relationship experts, and interviews couples who learn how to have a good divorce, so you can too. Now here's your host, Karen.
Hi, thanks for coming on back to the Good Divorce Show. I am Karen McNenny, your good divorce coach, and today we are going to dive into some financial aspects. Have you ever wondered, if we own a house, how will we divide the assets? How should I take my settlement? Is it better to take it in retirement or in cash? What do I do about the tax implications? Am I thinking long term? Well, all of those questions and more are going to be answered today as we chat with Melissa Murphy Pavone. She is a highly respected financial expert specializing in collaborative divorce. We're going to hear a little more about that. For more than a decade, Melissa has been guiding clients through the complexities of financial transitions. She does this both as a certified financial planner, also known as the CFP, and as a certified divorce financial analyst, CDFA. Melissa is offering a unique blend of expertise that empowers individuals to make informed financial decisions during one of life's most challenging transitions. Now, her passion for collaborative divorce really stems from her commitment to helping couples navigate divorce in a constructive, non-adversarial way. That's right, ladies and gentlemen. It's possible to have the good divorce and to come out with long-term financial security. Her background is comprehensive. Financial planning enables her to assist clients with asset division, tax implications, retirement planning, cash flow, you name it. When it comes to the dollars and cents, she's going to help you reduce conflict and simplify that process. When she's not out working with clients, she is a sought-after speaker and educator on topics related to divorce. Thank you so much for joining us here on the Good Divorce Show. Welcome, Melissa.
Thank you, Karen. Thanks so much for having me.
Now, often is the case, those of us working in the field of divorce find our way here through our own personal experiences. And although you are not divorced, you are a child of divorce. And I'm wondering for our listeners, if you wouldn't mind just going back in time a bit as to how that experience looked through the lens at the time and how it looks different now as a professional and as an adult.
Yeah, I always say my why is my mom. And when she went through her divorce, I was a teenager, I would say, in college, not quite in my 20s. And I wish I knew what I know now back then. So I could have given her better advice than she was given. They didn't have a great divorce. It was very drawn out. It was very expensive. And she made decisions with her heart instead of her head. And there are consequences for those decisions later on in life. And I really don't think that she knew what she was signing when she was signing it back then. And I want all divorcees to really be educated and empowered to make the best decisions for themselves moving forward.
Yeah, we really head into divorce with very little knowledge and end up relying on resources that are not always in our best interest. And I like to say, just because we're talking about divorce doesn't mean we're going to get one. Just like if we're talking about our future wedding dress, doesn't mean we're going to wear that dress or even get married. But we're so fearful of this area of family dynamic that we steer clear of it to the point of almost neglect and being underskilled when we do face it. And it sounds like that was part of your mom's experience. So let's just go down that rabbit hole, Melissa. What would you tell all the moms and the fathers who might be leaning in with their heart and the advice that you now know of why you need to bring your head along and in what ways?
I really think that you need a financial ally. And sometimes when the emotions are heightened, which often happen in divorces, we're not able to think long term. We're trying to get through the day. We're not thinking how this will affect us 5, 10, 20 years down the line. So having a neutral third party kind of look past today and look into your future for you, and just kind of sort of play the what if game, allows you to kind of see different options and bring some light to the table.
Hmm. I'm going to give you a specific example from a case study, a couple that I was working with. So often the asset of a home is going to be divided. And let's just presume we've got two reasonable folks who see the house as a family asset. It's going to be divided in half. They're taking equal custody time with their kids. They're paying for things equally, right? So very vanilla toast in that way. But here's this big asset, and one member of the family is going to retain the home, and the other is, if you will, going to be bought out. So what are the options for that buyout? And what should we be thinking about, not only as the person who's retaining the home, but the person who's receiving the buyout?
Yeah, so that's oftentimes a big controversial piece. You know, when clients come to me, a lot of people want the home. And part of the exercises that I go through are really finding out, do they want the home, or is that the last piece of the family? So it's kind of peeling back the layers of the onion to see, like, is it really the house, or is it like they're grasping on to family unit? Oftentimes they want to keep the house, but I kind of go through the cash flow to say, can we afford this house?
Right.
And is this house now too big if you're here alone and the kids are off in college? And can we maintain, because the cost of the house is hard to maintain, you know, with cost of inflation and everything else that's going up. And yeah, you might be able to cover the bills, but those big expenses like replacing the burner or the roof or a flood, those are the things that you don't normally think about that might not be on the annual cash flow statement or within your budget. Those are the things that you have to be able to make sure that your emergency fund has enough to be able to take care of those unforeseen emergencies.
Yeah. And I know there's a lot of people, what I say, are kind of held hostage by their interest rates right now. They bought a house and maybe had one of those amazing 2.5, 3.5 interest rates, and now we're at 7%. So
Yeah.
it is a process that if you're going to retain the home, often you have to refinance the home at the new interest rates. I believe this is a divorce penalty. I would like to see this policy change. There are some mortgage companies who are now seeing the light and allowing one spouse to assume the
Right.
terms of the previous loan, which feels totally appropriate. But of course, you still have to qualify to carry that loan on your own as
Yeah.
single income household and single income earner in your household. So that's lots of good advice about thinking long term. I know you want the home. Can you afford the home? Don't put yourself in such a vulnerable position.
Yeah, and oftentimes if you have to trade off assets, you now have the home that, yes, you're living in, but it's illiquid, right? You can't live off of the income from the home. And now you might be, you know, considered house poor and not be able to travel as much, right? Or not be able to do some of the things because you had to trade off assets in order to keep that house.
Well, let's talk about some of those assets. So let's say I'm going to retain the home. We've determined that I can afford it and it's good for the kids and stability. Now, the party on the other end, if I'm receiving assets from the house, so it could be cash. It could be other items, I guess. It could be retirement or stock options and tax implications. Can you walk us through all the ways that assets get shuffled around and kind of the long-term impact of what we should be taking into consideration?
Yeah, the titling of assets is very important. Oftentimes people just look at the balance, you know, a snapshot of what something is worth today. So if you're looking at a house, a emergency fund, a Roth IRA, or a 401k, they all have a balance of $500,000 today. They're not all created equal. And so really along the process, I help educate both parties to see the pros and cons of splitting certain assets or trading off certain assets because of the long-term consequences. Oftentimes people think that because they have the same face value as today, that they're equal, but they're not. Taking a retirement account worth the same amount as a money market account, you have access to that money market account, whereas you don't have access to that retirement account until you're 59 and a half without penalty. And then at 59 and a half, you have to pay taxes on that money. So those are the things that not everybody knows. And so I really like to increase everyone's financial literacy and talk about this throughout the process so that they make educated decisions on which assets are really important to them and which ones they're willing to negotiate or, trade off, if you will.
So go a little deeper. Let's keep adding to our financial literacy. I love that. I always think education, if we could have more relationship literacy and financial literacy taught in our first 20 years, we would probably be a little bit better off in our adult life. So IRAs, Roth IRAs, SEPs, when money is taxed going in, when it's taxed going out. Again, you're an expert in this. Many folks suffer the curse of knowledge. You know how this works, Melissa. But a lot of us, even when we're putting money away, we don't necessarily know the implications when it's coming out. So go a little more specific for us, because someone out there is listening right now and making these decisions, and they don't have a Melissa sitting at the table with them.
Yeah. So the Roth IRA, that money has already been taxed. So that account you still can't touch until you're 59 and a half under current legislation. However, you already paid tax on that. So it is after tax money when it comes out, as opposed to a traditional IRA or say your 401k from your company retirement account. That money is pre-tax and all of the growth is pre-tax. So anything that comes out of those accounts are going to be taxed at your current rate. So that makes a big difference if we're talking Roth versus traditional, or even if we're just talking a bank account versus a retirement account.
Right. And I know you're not a tax lawyer, but even like if I were to receive a big cash settlement versus something in retirement and capital gains tax, and I just think that we take taxes and we kind of set it aside when, like you said, we're just looking at the dollars and cents, but that's not the real value potentially.
Yeah. It happens often sometimes with the house too. If you sell the house and there's a large capital gain, and we see this a lot with gray divorce.
Mm-hmm.
They bought a house 20 years ago, 30 years ago, have huge gains within their house because think about the housing, market and where it came. In hindsight is 2020. We all wish we bought more real estate in the past, right? But if you go to sell that house as a married couple, you get to exclude $500,000 of gains. As a single person, you only have a $200 exclusion. So if you have a lot of equity in your house, it's something to take into consideration, whether you're selling that house as a couple, married, or if you're selling it as an individual, and what that looks like.
That is such a valuable tip. And you use this phrase, gray divorce. And for you listeners like me, you might be going gray. It just means aging, maybe post-retirement, people who've been holding on and are finally like, you know what? We got one more chapter in our life, and I think it'll be happier if we do it separately. And I had a couple just like this who their home, all their paperwork was done. The house was going to go on the market. And we took all their settlement papers and just kind of stuck them in the crock pot and said, for this year, you're going to stay legally married. You're going to sell that house while you're married. You're going to take that $500,000 benefit. And then on January 2nd, we're going to file your paperwork.
Yeah.
And then the IRS will know that you're divorced. A lot of people don't realize, as was the case with me, before getting deeper into the divorce world, that if you are divorced for any part of the year, the IRS considers you divorced for the entire year.
Yeah.
There's pros and cons to filing together, married but separate, just individually. Another thing that I think people don't necessarily see or consider, we can tap the brakes or push the gas pedal on our own divorce. Have you seen this with clients as well?
It did, yes. And it comes into play with a lot of different transitions within their life, if it's with job transitions, when it comes to like losing healthcare insurance before getting on Medicare, kids going to college, when it comes to the FAFSA form and filing for financial aid. So there's all sorts of reasons why you might be better to, like you said, tap the brakes or accelerate it based upon your individual circumstances. And it's one of those things that's so unique to you and your family and your numbers that it's not just generic advice that someone can just tell you, right? You have to do that deep dive. You have to have a coach. You have to have a financial advocate to really understand your family's financial landscape in order to have the best outcome.
Oh my gosh. Listeners, we are chatting today with Melissa Murphy Pavone, and we are going to continue this conversation, diving into her knowledge as a certified financial planner and divorce financial analyst, as we talk a little bit about not just the numbers, but also the attitude and the environment that we create for one another as we walk through divorce. Stay tuned.
Are you thinking about getting divorced? Before you call a lawyer, call the Good Divorce Coach, Karen McNenny, a certified divorce counselor, co-parenting specialist, and mediator. Karen's signature Good Divorce experience will guide you through your divorce journey, from the day you make that difficult decision to the day the decree is signed, all for a predictable fee. The Good Divorce Coach will teach you and your partner how to get divorced and be divorced with less conflict and less debt. Visit thegooddivorcecoach.com to get in touch with Karen.
Now, back to the show with Karen.
Welcome back. Thanks so much for hanging in there today. We are chatting with Melissa Murphy Pavone. She is a CFP and a CDFA, and we're going to start there, Melissa. Can you tell us the distinction between all those letters and what they mean, and when we're shopping for our divorce team, what we need to think about?
We always call it the alphabet soup at the end of our names. So CFP is Certified Financial Planner. And that is a designation given to financial planners going through rigorous training to make sure that you're a fiduciary and you're always putting your client's best interest first. It's kind of the gold standard for financial planners.
And
The
you did
CDF
another fancy word. I'm going to interrupt. Fiduciary, right? Like, again,
fiduciary.
these words just roll off. But again, it's something to look for. So can you specify again for our listeners what they should be looking for and why it matters?
Yeah. Making sure that your financial planner is a fiduciary is making sure that they're putting their best interest, your best interest above their best interest. There is a higher level of ethics involved as well as transparency for all fees.
And there's a governing body that oversees that when you have that designation.
Correct.
Right. So it's the difference between going maybe to the masseuse on the beach versus the one who has a license in brick and mortar. They both might do the job, but which one are you going to feel safer with and know that you're going to really get the service that you're looking for? So that's good. Okay. So from CFP, once you got the money, what are you going to do with it? But the CDFA is a whole new arena. I don't know how long this designation has existed. Do you?
I want to say 20 years, but don't quote me on that. It's a newer designation.
Kind of like divorce coaches, myself as a consultant that offers a lot of wraparound services, we're beginning to see that when you're moving through divorce, you probably want more than just a lawyer, right? They're going to do well to get that paperwork written in a way that it's enforceable by law and interpret the law, but there's so much more going on in this transition. So tell us about what do you have to do to become a CDFA, and why would one of our listeners want to seek one out in their own journey?
Yeah, certified divorce financial analysts are trained specifically for financial advising through the divorce process. So we know all of the ins and outs around the different settlement options, if you will, to guide you to make the best decision for your family. So I think the combination of the two, they both take a holistic approach for your family's finances. And the CDFA is definitely important when you're going through a divorce.
Yeah. And the CDFA often shows up in what's referred to as a collaborative team in the collaborative divorce process, which again is a very specific approach to divorce that is guided and overseen by the American Bar Association and recognized as such. And you've sat at the table in that process, Melissa. Can you tell us more about this collaborative divorce approach?
Yes, I am very proud to be on the Long Island Collaborative Divorce Professionals team. And we were collaboratively trained. All the professionals that are collaboratively trained have first gone through mediation training and then a second layer of collaborative training. And we all take an oath that we are going to stay out of court and be non-adversarial. And I think that's really important. What's unique about collaborative is that there are two attorneys. So each spouse gets their own collaborative attorney kind of in their corner. And then there is a financial neutral, which is often a CDFA. And then there is a family specialist, often a parenting specialist or a mental health professional that acts as the facilitator. And the four individuals, along with the two spouses, work together as a team. And the goal is to save time and money and to work collaboratively.
And clarify for us, because there's a couple of words you're throwing around out there, financial neutral versus financial advocate or advisor. What's the distinction there?
So as a certified divorce financial analyst, I have the ability to work in two capacities. One, as a neutral, oftentimes a mediator, such as yourself, will be working with a couple, and maybe that there's just one issue. Maybe it's the house, or maybe it's restricted stock options, or something there that they just can't get past. They don't know how to move forward. And so I can get brought in a neutral capacity to educate both spouses on options and the long-term consequences of those options. And so in that place, I'm there as a neutral. I'm not picking sides. I'm not advising anyone. I'm just giving options and educating. And that's how it works in the collaborative process as well. We're going through it and they're negotiating, and I give, solutions and pros and cons and just the financial options. And as an advocate, I get brought on where either the attorney or the client can call me directly and say, this person needs specific help. I need you to help them. And so I am sitting in their corner looking out for their financial best interest only.
Mm-hmm. And what is the optimal time to call someone like you in their divorce journey?
I always say the first person you should call is a coach, because you need emotional support. But I hope the second call would be a CDFA, because even before you get to the mediator part, I can help with the financial affidavit and trying to get all of the financial worksheets together. And so that financial organization is a really important piece to it before you might take that next step.
Well, I really appreciate your wisdom and insight. And I always say, call a coach before you call a lawyer. Family before finances. Stabilize the couple. Stabilize your living situation. How are you going to talk to the kids? What do they need? Start there. And then once the family and the individuals, right, again, have some stability, then the next thing we start thinking about is how are we going to divide all this stuff up and to get you on board. Now, financial affidavit. Again, can you give us a little insight of what is?
Yeah, before you decide you're going to divide anything, we have to know everything that there is, right? And that's your balance sheet, your assets, and your liabilities. And sometimes we don't know all of those things if one spouse is kind of the CFO of the family and takes on that role of paying the bills and taking care of the finances. So through that discovery phase, we locate all of the assets. The titling of those assets is really important, as well as any liabilities. You mentioned earlier about the house. That's something that you want to see. Is the mortgage assumable? Is that even an option? And what those bank underwriting requirements would be. So let's get ahead of that, because that might affect how we structure our maintenance, our maintenance moving forward based upon what we need to prove for our income. And if they accept maintenance as part of income. So each mortgage company has their own underwriting department. So to find out what that is super helpful. But also to think about cash flow, like what looks differently and what are you spending now? And it's definitely going to go up after the divorce because we're now going to have 2 locations, right? I say we need 2 bottles of ketchup, and that sounds silly, but the house has to be stocked, right? For both, we need sheets at 2 places, and kids need bedrooms at 2 places. So the expenses are definitely going to go up, but to be realistic about that, to make sure that everybody comes out okay.
Well, let's just say there's somebody who's like, I've really been doing most of the work around here and I've been the earner. And they just decide they're going to either they have been making a little private stash for themselves, a little cash under the mattress, so to speak, or I'm going to take a bunch of money and go buy a gift for my brother. And then after the divorce, we're going to go sell that Jaguar and I'm going to get that money. Right. I don't want to believe that people will do these things, but not everybody walks through the world like I do, and that it can happen. So what are the consequences and what should we be watching for and how do you find this stuff out?
Yeah, unfortunately, it happens more commonly than you would like to hope. One thing I always suggest for clients is to pull their credit report and to see what is open within their name. Oftentimes there might be credit cards that were opened in joint name 20 years ago. You have no idea where the card is, but there's still a $20,000 credit line and nobody's used it, but someone can call up and have access to it or take a cash advance. Or so once you flag your credit and take a look at what avenues are open, that's a good way to make sure that none of those financial infidelities happen during the process.
Great advice. And if you really start to suspect something has gone missing or there's more money somewhere, this forensic accountants, is that something you can speak about?
Yeah. So a CDFA can do some forensic accounting work, and we often, depending upon the case, will refer out to a forensic accountant. But to do separate property tracing, oftentimes we might come into the marriage with assets that were just ours, and now we're adding to them during the marriage. And now it could be commingled with separate property and marital property. And that gets complicated, right? Depending upon what state you are and what the laws are when we're going to say, is this something that we're going to divide or is this something we're going to, not divide? And so that's where the forensic accounting comes in to kind of go back in time and see what the snapshot, the value of it was prior, to getting married. Also, if there's assets that you think that are missing or hiding or in somebody else's name, they can help locate those. Something that's really hard to deal with is when there's family owned businesses. Oftentimes, family owned businesses, a lot of their cash flow and their lifestyle is run through the business.
Yes.
And so that gets complicated to say, okay, well, my business is only worth 50 grand, but all our cars and our car payments and our gas cards and all of our dining expenses are run through that same business. So a forensic accountant can come and help look at marital waste and look at a lifestyle analysis and really decipher what the business is worth in order to have a fair settlement.
Yes. And I hear you alluding to kind of reworking your personal budget. As you said, you're going from a 2-income household to a single income household and all the things you're taking into consideration. That part of this process really is writing a new budget for yourself as you walk through the journey. And you look, like you said, don't be short-sighted. What is the long term? How are you going to be able to continue to fund your retirement? Pay for that house you want to retain. Do you still get to go to Hawaii every February? Is that something that you also do with clients, is help them reconsider their budget and their lifestyle spending?
Definitely. And I like to do it if I'm brought in early enough in on the case through the divorce process to do it realistically so that we don't have to go back and recalculate maintenance, right? If we get the numbers right the first time, if we're really honest and look at what our future is going to look like, then we can have a better projection of what we're going to need for like a needs analysis. But yeah, it's really peeling back the layers of the onion. Sometimes I get brought in just for post-divorce transition, right? The divorce is over. They were awarded, whatever they were awarded, the assets, and now one spouse who's never written a check or paid a bill or knows about taxes has a lump sum of money and has to figure out how to live on it. And so I've been brought in those cases, and that's really empowering work to really educate someone about their financial situation, empower them, and teach them along the way on how to be financially responsible.
So you've thrown another word out there, maintenance. And I'd like you to give a little education about what maintenance is, what it's not, AKA child support, when it gets awarded, when it doesn't. Not every state does it. So break that down a little bit for those of us who are learning all this jargon for the first time.
I know I forget that we use all these words that just flow
They
out.
just roll right out your mouth.
I know. I try not. It's like on the doctor's show when they're, doing a procedure and they're asking for an EKG and a CBC. So maintenance was previously known as alimony and awarded to the spouse to kind of level the playing field based upon their income. And it's based upon how long you were married, your earning potential, all of those things. Not every state gives it. The laws recently have changed regarding the taxation of it, but it is separate than child support. Child support is given to help the custodial parent offset the costs of the children's needs. And so the duration of those two things are very different. And so the timing wise, some spouses receive both, right? They'll say, okay, I'm getting maintenance and I'm getting child support, but those two faucets, if you will be shut off at different times. And so you have to be working with someone financially to know, okay, the money that I'm going for alimony is only going to last X number of years. Then I still have child support. And then once my child turns this age, child support is shut off. And now I'm not quite yet at retirement. So what does that look like? So filling those gaps and working backwards is really important for cash flow.
And remind our listeners what state you work in.
I'm in New York.
And New York, maintenance seems to be something that can be negotiated and asked for. I'm in Montana. It's really rare.
Really?
I have clients in Texas, really rare. Clients in Colorado, pretty common. So this idea, and I've had those clients where they've already decided like, oh, I'm going to get alimony and I'm going to get child support and I'm going to get the Jaguar and the house. I'm like, well, don't start spending your coins until you know how many you have. And it is shifting away from, again, maintenance. Don't presume that your state, and this is just one of the things about the great US of A, we do have independent state autonomy. And there are also federal guidelines, and they're not all the same.
Yeah.
And I'm guessing that someone in your situation and your designations and licensure, is it specific to New York, or can you support individuals outside of your state?
I can support individuals outside my state, but for the most part, I do New York for when it comes to divorce. But it really just depends where they are in the divorce process as far as, do they need neutral work? Do they need advocacy work? Do they need collaborative?
Something that I'm really noticing as you talk about your practice and your relationship that you build with your clients is that it doesn't sound like adversarial, like we're using divorce as this weapon for one person to get more and one person to get less, that there's more of this holistic lens of the family, particularly when there's kids involved. Am I just making that up, or is this?
No, you nailed it. My company is called Mindful Divorce Partners. And so I really want people to be mindful through this process, because it's hard for everyone. But like you said, it doesn't have to be bad. And so really, I'm a big proponent of the education piece. And so the financial literacy and the education and just looking kind of outside the box, just because the law says this is how we do it, right? The beauty of mediation is that you can craft something that works best for you and your family. And I think that's really important. And without a judge who's never met you or known you or your kids or your family or your individual circumstances, you have the ability to really do this in the best way possible with neutral people that want what's best for your family.
And that we do have the power to design our divorce, right? Not
Yeah.
divorce by default, divorce by design, by the two of you. And if you feel like, I'm hearing this today, I'm hearing Karen and Melissa talk, and it sounds like a fairy tale because I just want my spouse to fall off the face of the earth. It's possible you've stayed in that marriage too long. And that when we see the opportunity to exit, when we start to feel that itch, that might be the time to begin to educate yourself so that you can do it in a mindful, intentional way. You do not have to wait till the house is on fire and everybody's at each other's throats and you're hiring the shark lawyers and it's a zero-sum game. Please, Melissa and I are here to tell you that is not your only option. And by all means, try to run the other way from finding yourself in that situation. It's kind of like a teeter-totter, right? Especially when we have parents with kids, we don't want one who's elevated and really leaves with all the resources and one who has very few resources. That's not in the best interest of your kids.
No, definitely not. I had a case recently where the couples were getting divorced, and the husband said, my wife really needs a financial coach after this process, and said to the mediator, listen, like, I'm going to be fair, but I still want her to have some guidance. I want to pay for her to have, that financial planning after. And it was the most amazing thing, because usually at the table, right, you're asking for this and no, I want to claim the kids. I want the credit. I want the house. I want the car. I want Thanksgiving and Christmas. And it was so refreshing to say, hey, like, I'm going to give you this money, but I want you to be wise about it. And I want it to last for you and our children. And so here, I'm going to help give you this professional service to help you along the way. And I thought that was like just so special.
So classy, right? There was a love story and children are born from love. And we don't have to throw that out, right? It's not like either this or that. It's yes and. And I'm happy to report, Melissa, I had a very similar case recently. Gray divorce. Dad paid all the bills, was the earner. Mom was the housemaker. She was getting, over $500,000 to see her through to end of life. And he, as their divorce consultant, he's like, Karen, can you find a CDFA? Can you find I can't do that work. I'm not going to be her teacher anymore. And she needs to be empowered to do that herself, and saw that from the goodness of a place of compassion and kindness. And if we can just bring more of that to the table, everybody does better.
Yeah.
Yeah. I have two final questions for you, Melissa. One personal, one professional. As a child of divorce, we have parents who are listening to us today. And if you were to go back into that voice, your teenager, as you were moving through this, what would you have wished your parents would have done differently for you, that you would encourage other parents to really take into consideration right now as they become one family that lives across two homes?
I think the financial communication is really important, and to keep that communication throughout the process is really, really paramount. And that it just shows good sportsmanship, right, with the kids, and leading by example, and the type of children and character that you want your children to have, to be classy about it and to really communicate.
And for both people, like you were telling your case study and mine, that you do want the best for each other. You just don't want to be together.
Yeah, and that's fine.
And that's fine. Yeah. So Melissa Murphy Pavone of Mindful Divorce Partners, what final advice would you like to bestow upon our listeners today?
I think if you are going down the route of divorce, to build your team. And that starts with a coach and then a financial and then possibly a mediator or attorney. But create that support system for you and your family, and be honest and open, and give yourself grace through the process.
Wonderful. Where can people find you and lean on you for additional support and resources?
Yeah, my website is mindfuldivorcepartners.com. I'm often on LinkedIn. I offer complimentary consultations. Happy to just, if you need to pick my brain or have an idea, or, are stuck on something, I'm happy to assist.
Is so generous. We'll make sure that Melissa's contact information and details are in our show notes. And just congratulating you, listeners, for taking time out of your, no doubt, very busy day to invest in yourself and your education as you continue to follow all the advice here on the Good Divorce Show. And by all means, if you are finding this valuable, please leave a few comments. That helps us to continue to promote the show so that others can also receive this advice. And you can always find me over at the Good Divorce Coach. There is a link there as well for a free 1-hour consultation to grow your own support. And by all means, if you are needing a guide through your divorce journey for you and your spouse, please reach out. And remember, everything will be okay in the end. And if it's not okay, it's not the end.
Thanks for listening. Do you have questions or thoughts about this week's episode? Let us know by following the Good Divorce Coach on Facebook and Instagram at Good Divorce Coach, and leave a comment. And be sure to tune in every Monday at 10 a.m. Pacific, or listen anytime wherever you get your podcasts.